Hello, everyone, and thank you for joining Sax today to discuss the recent issues in the U.S. banking system. Today presenting will be myself, Jerome Fusco. I lead up our Sax Capital Advisors, which is our M&A and strategic advisory practice within Sax. And also today will be Jeremy Rhen. I'll let Jeremy introduce himself.
Hi, everyone. I'm Jeremy Rhen with Sax Wealth Advisors. I'm a certified financial planner with about a decade of experience and work with the wholly owned subsidiary of Sax, our wealth advisory team that manages about 1.6 billion in assets. Thanks for having me, Jerome.
Thank you for joining. And thank you all for joining in. And before we begin, please feel free to ask questions throughout the show. We do have a digital pop-up, so hopefully I will be able to see them. And if I miss something because of timing, we will circle back to Q&A at the end as well. So thank you again, everybody, for joining. So a little bit on the agenda today, what we'll discuss. First is the situation update, a little bit of why we are here, what's happened over the past 10 days, and what's led us to where we are today, and what do we see going forward. A little overview on how banks operate. I think before we go into what happened with each, we'd like to just give a brief 101 to level set some of the audience to get a good understanding as to how banks financially function, and it'll make the rest of the discussion helpful. The next bullet will be on Silicon Valley and Signature, a little debrief on the situation, and then some of the things that led to the panic and the receivership status there today. And we'll go over a little bit about what the Fed messaged prior in the month on key risks in the economy and some of the issues they thought were critical to address. And then finally, we'll go into what does this mean and what do we want to watch going forward. And then what are some other things we might expect to see and some cautionary principles that we'll have. And then Jeremy will go into some of the Sax Wealth Advisors insights for personal financial planning and other potential risks. And finally, we'll open it back up to Q&A, which will allow all of you to ask the questions you have. The next slide. So a little bit on the situation overview. And this really started about 2 weeks ago, started getting steam with some weakness or perceived weakness in other banks. And over the weekend, 2 major depository institutions, SVB and Signature, were put into receivership by the Fed. And what that really means is there was an issue on their solvency and on the liquidity in the banks. All senior managers of both banks had either been terminated or will have been let go, and all the equity holders are likely going to lose all the investments. Now, each bank faced different types of issues. Some were similar, some were a little bit different. These all created great concerns that led to a potential bank run on Signature Bank, and then an actual bank run on SVB last week. And then ultimately, both banks had extreme risks of insolvency. So the thought was that they wouldn't be able to operate or function or pay out all of their deposits. Despite a current FDIC insurance limit of $250,000 on all accounts, the Fed backstopped all deposits at these institutions and put in place measures to backstop other community banks and regional banks. And this is probably one of the largest takeaways and benefits and reasons for the Fed to step in, that despite if you had $10 million at SVB or Signature, you were still fully backstopped. So the $250,000 limit was not observed, which was good news, because there was a lot of concern over the weekend and even into Monday whether or not people would be able to access all of their deposits, which is critical. And the reason the Fed had to step in was to ensure the health of the U.S. banking system. Now, and finally, we'll go over a little bit about what and who will foot the bill ultimately. So while there will be a price tag that will be borne by certain banks and other institutions, and you can argue that the taxpayer or consumer will eventually be on the hook for that, we do believe that the importance of doing something and ensuring the health of the U.S. banking system would have outweighed a potential down the road tax tag. On to the next slide. So as we're going through it, we thought it would make a lot of sense to walk you through how a basic bank operates, as a lot of the businesses that we think of in traditional manufacturing and distribution and other professional services, from a financial standpoint, specifically on the balance sheet, operate very differently. So if you think about starting a bank, if you were to fund a bank, let's say you and a group of friends put $1,000 into equity, your opening balance sheet will look like $1,000 of equity coupled with $1,000 of cash on the balance sheet. You then take in deposits. Let's say we opened a bank's doors and we get a new customer or two and they bring in $200. Now, unlike your balance sheet on a traditional business where cash and deposits will sit on your asset side, on a bank side, a deposit is a liability because it is something that you pay interest on, and it's something that will be eventually paid back to the customer, in this case, also the lender of your bank. So let's say, for example, in step 2, we take in $200 and we now have $1,200 worth of assets. In step 3, we need to start helping out our customers and growing, so we start to make loans. So we take $300 of our $1,200 and we start to make loans. So we still have our $1,200 worth of deposits and our $1,000 worth of equity. And now we're starting to generate loans. And then in the final step, we need to pay interest on deposits and make money for the shareholders. So in order to do that, we need to invest some of the money as well as making loans in order to pay back our rate on the deposits. So we take $900 of the cash and we invest $700, generally in very safe fixed income rate products such as mortgage-backed securities or other type of government loan products. And then that allows us to pay our depositors a rate on their money in the bank so that we can operate. And this over time will lead to us generating cash and returns for our shareholders, as well as making new loans and managing our cash and investments appropriately. The tricky part is ensuring that, or I should say what banks are faced with, is ensuring that you have an asset and liability matching and not a mismatch. As this comes over time, the more cash and investments that you get on, the more loans you make, the more it's critical to make sure that your maturities are matching your risks, and that is risk management that banks have to deal with. Next slide, please. As we start to discuss the next key topics, I think it's very critical to note that a few things to note before we get into it. First is that the structure of the U.S. banking system is built on trust. If you think about community banking, it ensures that customers will, on an ongoing basis, keep deposits in with banks and other institutions as they make loans and as they continue to do business with them. Most, if not all, banks in the U.S. would not be able to survive every depositor coming in and withdrawing money. So whether you're the size of Chase, Bank of America, Citigroup, or if you're a small regional bank or community bank, it would be almost impossible to survive a bank run, which is why the trust factor is so important. If you think back to the previous slide, your cash, a lot of the investments are tied up in other parts of the bank. Another thing that's important to note is credit risk drove the 2008 banking crisis, the previous one that is getting looked at now. The current issue is not credit driven. There's not been massive defaults on auto loans and home loans. It has been instead driven by interest rate volatility and liquidity crisis, which we'll get into later. It's also important to understand what an unrealized loss is. So the simple way to think about that is that it's a loss that would happen if you sold an investment today that does not have to be recognized on a balance sheet. So if I have an investment that I bought for $100 and its current value is $90, I would have an unrealized loss of $10. It is not a natural loss because I had not sold the investment yet. So that's going to be critical later on. And then another principle that needs to be that is important to note is that as interest rates go up, bond prices go down. So if I bought a bond 2 years ago and it had a face value of $100 and it was paying a 2% interest rate, given that interest rate environment has gone up and today bonds with $100 pay 4%, the value of that bond in the market would go down accordingly to make up for that 2% drop in interest rates. Next slide. So let's get into a little bit about what happened with Silicon Valley Bank. And this rising and falling action kind of gives a time period from 2019 to 2023 where we are today as to what went on. So a little background on Silicon Valley Bank. They were a bank well known for making loans to VC companies or pre-VC companies or other growth companies that were often technology based, but not necessarily, could be very early stage banks. They made primarily business loans, and they've been around for a long time. They actually had issues during the first tech boom in the early 2000s as well. So this wasn't the first time there was a concern in the bank. So during this time, they became able to gain a lot of traction from new business customers, especially in the technology sector. So they increased their deposits, and their customer composition mainly focused on businesses. They also increased loans to customers in technology and early stage businesses. So if you recall 2019 to 2021, even before the pandemic began, there was a lot of emphasis on technology. And then once people were remote, technology became even more critical going forward and more of a place of growth and a place of emphasis in the US economy. And then what also happened was, along with increasing loans to customers, they also increased their portfolio at this time. And given that interest rates were low, they were investing in low yield instruments on their investment side. So up until 2021, 2022, their average investment loan book was getting about 2%. So fast forward to about 2022, there was a little bit of headwinds in the economy, and the IPO market dried up, and which led to a greater cash burn for companies. So companies who were doing business with Silicon Valley Bank, who might have IPO'd and had greater cash on their balance sheet, were now burning more cash because of a lack of IPO market and a lack of liquidity there. So they were using more of their deposit base. Interest rates rose. This driving bond prices down. So if you think about what I said previously on bond prices going down as interest rates go up, this really impacted SVB greatly because they were investing at a low interest rate market, and now the bond prices were going down, impacting the investments on their balance sheet. Depositors were also leaving for higher rate loans. Technology today allows people to move their money a lot quicker and a lot more visible as to what the market looks like. So you can see, different interest accounts paying 4% or 3%, given SVB's portfolio was tied to a lot of products on the investment side paying 1% to 2%. They couldn't necessarily offer those products, so it became an issue and lost customers that way. And then finally, last week, they had a failed capital raise, so they wanted to raise capital to shore up their balance sheet and provide more liquidity to investors. It did not go well, and then management had poor messaging around the reason it failed, and then that led to a lot of individuals in the VC community Tuesday and Wednesday telling their portfolio companies and their investments to withdraw money out of Silicon Valley Bank, which led to a run Thursday, which got into the greater public through social media by Friday, and trading was halted, and that's how they got placed into receivership. Next page, please. So if you look at financials briefly, how things changed between 2021 and 2022, I'm not going to go through every part of the balance sheet, but really their deposits and their debt really increased. The deposits decreased a lot, by roughly $15 billion, and their debt went up by about $13 billion between the 2 years. And this shows some of the deposit cash burn as well as people leaving, as well as the $13 billion of debt raised, and that debt was done through the Federal Home Loan Bank. So the FDIC had even more incentive to come and step in, given that the $13 billion in holdings was due to the U.S. government. It's also important to note that their balance sheet stayed relatively the same on the asset side, so the cash remained in a relatively good position, and the investments increased with the loan increase. Now, if we fast forward to the next page, though, if you recall what we said about unrealized gains and losses, every bank on its balance sheet will not only put the actual losses, but what they have unrealized in their portfolio. So if you look at SVB, and this was brought up a few months ago at year-end by some Wall Street analysts, they had about $16 billion of potential loss on their balance sheet from their investment portfolio on an unrealized basis, meaning if they sold everything off and cashed in their whole investment portfolio, they would have had a $16 billion loss. And if you think about that from a balance sheet perspective, that would have wiped out all of their equity because their deposits weren't going anywhere from the transaction. Their debt wasn't going anywhere. So it would have wiped out all their equity and thus giving them no capital buffer for a bank run. When a regulator sees something like this, it does cause a lot of concern, which is why you'll hear things like stress testing and capital adequacy done in many instances. So all of this confluence of events led to where we are today in putting Silicon Valley Bank into receivership. Next slide, please. The Signature Bank issue was a little bit more nuanced and it took a lot of people by surprise, mainly because it happened over the weekend and also because it wasn't well published. It was whispered by different creditors and depositors of Signature Bank, but it also did come as a surprise on Sunday night when the Fed announced they took over this bank as well. Signature was also a very business-friendly lender and a large proponent of cryptocurrency. They're one of the few banks that took cryptocurrency as a deposit, and that created a large pool of uninsured deposits on the balance sheet, as crypto is not insured by the FDIC. In the wake of SBA, Signature experienced a massive deposit run, according to people familiar with the situation, late Friday, leading to a lot of the deposits coming out of the bank and a weaker cash position. It's also critical to note that the co-author of the Dodd-Frank Act, Barney Frank, was a board member with direct oversight into the bank's risk management. So we'll get into this later, but as you can imagine, the blame game has already started being played. And we've heard people playing both sides of the aisle. And this is one of the legislators who helped write the bill years ago, was on the board with direct oversight, and still did not have the proper regulatory matters in place to prevent this. Ultimately, regulators felt the bank fundamentals were misrepresented and failed to provide reliable and consistent data. So when the Fed clearly got a list of different banks that could have potential issues and went in there over the weekend and likely had very strong discussions with senior management to understand what exposures were. And one thing that will not help a bank's cause is if you cannot provide reliable customer data and valid answers. So if the Fed's asking to see specific stress testing or what percent of the deposits are crypto and what percent of deposits are susceptible to a run, or what does a stress test look on your investment portfolio, that will give regulators pause and can cause them to close the bank. And as we finally mentioned, the regulators lost faith in banks management. And in order to stop a systematic risk, which is a greater run, they thought it was critical to intervene into this current situation. So that's a little bit about the kind of qualitative aspect of Signature. Next slide, please. If we look into some of the things that really stuck out in terms of Signature, in just over a year, their cash position went down by about $23 million, which is something clearly a regulator would not like to see. Their investments and loans did increase, not offsetting, but did not offset the increase by cash. In terms of their liability side, though, their deposits went down by roughly $20 million, and their debt went up by about $9 million. So if you think, so the latest estimate were that 20 to 25% of deposits were crypto. And if the Fed is discounting that as a big liability on your balance sheet, there's one cause for concern. And then, the increased borrowing, similar to SVB, was done directly through the Federal Home Loan Bank. So the debt was really going to be borne by the taxpayer or the bond payers for that not to be able to service this debt that they owe to the U.S. government. And while the equity situation, if I were to run the same analysis that we did for SVB, was not as dire as Signature, it was still a concern. This led to the likely receivership placement of Signature Bank. Next slide, please. One thing that I and others have found very interesting, that on March 6th, so literally, a week before all this happened, the Fed Chairman Martin Gernberg at the Institute of International Bankers had a discussion with key people about different risks, and they do this often. And they're recorded and they're presented, and they get scrutiny from time to time, not as much as one given in relation to rates increasing, but they highlighted a few interesting areas that I thought were worth bringing up today. One was, continued banking will have economic uncertainties due to certain things that a lot of you are all experiencing. Supply chain bottlenecks and difficulty of employers finding qualified workers. Interest rate risk. So again, this one is very relevant because they said specifically when interest rates were lower, their bonds are now worth lower to banks, and that most banks will have some amount of unrealized losses on their balance sheet. So this quote is almost foreshadowing what happens a week later, and then they finalize it with unrealized losses they have meaningfully reduced banks' balance sheet. So the reason I'm highlighting this today is this is not something that necessarily caught the Fed by surprise. This is something that they were expecting. I don't know if the velocity and the impact was quite what they were expecting. I have to believe it wasn't, or they would have had different measures. And then finally, credit risk. As I mentioned earlier, this is not a credit risk event. However, the Fed does message this as a real concern. It says that business lines could be sensitive to price inflation, including lending for autos and credit cards. And then finally, in the last point, it's saying, we think that cash-strapped consumers could experience greater repayment difficulties as day-to-day living expenses increase. So the Fed is acknowledging everything that we continue to know, that rising interest rates can leave companies and customers in a precarious situation. But it's interesting just to hear it and see it and have something like this as you're contemplating this, along with how they manage interest rates going forward. So next slide. So just wrapping up, and this is our goal to have to keep the presentation relatively brief and give time for Q&A. But what this means, the first bullet, which I think is great, that the Fed will ensure deposits beyond the insurable amount that warrants safety to the U.S. banking system. Basically, our government is going to do whatever it takes to protect depositors, right? So while 250,000 is what's printed, it was pretty obvious over the weekend that they were not going to let anybody lose money, which is great for our banking system. You don't want banks taking unmeasured risk with deposits and acting feverishly, but we do need the safety of a banking system in order to operate businesses going forward. Large banks may become flush with cash, and deposit rates could drop further. So as the weekend happened, more and more people were running to the Chases, the B of A's, and the cities of the world, larger institutions, to put cash in there. And as they have more and more funding, their cost of funds will be lower because the needs for deposits will be less. So if I don't need as much deposits, I'm going to start paying lower rates to those customers. There will be a hunt for the next victim, and that might be more of a social media, Twitter kind of phenomenon. People looking through balance sheets, see who else looks like they could be next based on some of these metrics. What I would say is I take great credence in the fact that I believe the government has gone through and looked at some of the riskier players locally, especially for you calling in from New Jersey. The banks like Columbia, Valley, M&T, Provident, other who do a good amount of business in the local community, we looked into over the weekend. And if you did all of the ratio analysis that I did for this presentation, which we did run on the other banks, there's a lot more stability. We were actually in a very reassured place that those banks were very stable. Now, as I said earlier, no bank can survive everybody coming in and taking out every penny of the bank. That wouldn't be good, but we have a very, very good opinion on how those banks are operating, and we'll be able to continue to operate going forward. There will be higher scrutiny on the Federal Reserve interest rate actions. So as you've noticed, fluctuations in the stock market have been driven by if the Fed will eventually start to lower rates and get items more manageable to borrow costs to make buying houses more reasonable. And the Fed, led by Powell, has been on a path to try to increase interest rates and get inflation under control. Its new variable is now the health of the U.S. banking system. While the Fed doesn't traditionally look at one specific subsegment as a reason to raise or not raise rates, given the importance of the US local banking system on our economy, I believe that the Fed will take this very much into consideration and likely pause a near-term rate hike or give further guidance on how it plans to manage a mismatch in interest rates with a mismatch in interest rates with their portfolios. There'll be equity market volatility anytime uncertainty is in the market and investors don't know where to go. Equity markets usually can experience days of great increase and great decrease, like we saw Monday and Wednesday, and again, strong days like we saw yesterday. I expect all of the banks to come out with strong messaging with regards to capital adequacy. If I were a senior manager of a bank, I would want to ensure all my customers that we are in a good financial position and be able to show it in many different metrics. That reassurance has already started coming out. We're seeing message coming from nearly all of our banking partners over the past few days. And then the blame game, as per usual, both political sides, we will likely say it was your fault for this measure being revoked, or this measure should have been in place, or you missed it. This is nothing new. We try to generally ignore this and stick with the main picture. We just want to understand what's going forward. There's no real value in looking backwards. So from our perspective, as we sit today, we feel good about the local, regional, and overall U.S. banking health system. But we do think it's critical for all of our clients and stakeholders and other partners to have a good understanding of what's going on. Perhaps take a little bit different approach to operational risk, which we can get into a little bit later. But basically, ensuring that you have access to maybe a secondary case of funding, not just for something like this, but in case some operational issue were to happen to your bank where they were closed for some unforeseen reason. So I will pause there, and then for how it can impact people's wealth personally, I will flip it to Jeremy.
Thanks, Jerome. So again, I'm Jeremy Rhen with Sax Wealth Advisors, and I think Jerome laid out the scene very, very well from a high level and kind of the details of what happened with these two particular financial institutions. The questions that we've been getting from our individual and small business investors that we work with doing financial planning and wealth management, are mainly around the idea of how does this impact me as a personal investor in the markets right now. So I think the biggest thing, which Jerome mentioned, was investors in these failed bank stocks are not being made whole by the government. So if you held SVB stock or any of these banks now that are moving into receivership, basically the story is you took a risk investing in that company directly, and therefore that is your financial loss. Now the statistics bear out, I think about 2% of holders of SVB Bank, for example, I think were individual investors. About 53% of it was held by mutual funds and ETFs. So for our portfolios that we manage for clients, pretty much any portfolio that has S&P 500 or US large cap diversified mutual funds in it, you do hold a sliver of some of these banks in those funds. The biggest holders, the top 10, I think, of Silicon Valley Bank were Vanguard, BlackRock, State Street, JP Morgan, Fidelity, iShares, even the government pension fund, I believe, were all on that list. So if you had large cap stock exposure, you probably had a very small sliver of your portfolio that was exposed to this. I know for us personally, a lot of our clients who we invest money for, we use Dimensional Fund, DFA. They had, based on our conversations with them and kind of our own research, somewhere between a 10th and a 100th of 1% exposure in their large cap and US market equity funds and ETFs to Silicon Valley Bank in particular. So we advocate for diversification within our portfolios and our clients' kind of recommendations that we provide. And certainly that is why we do it. One stock does not sink the ship when an event like this happens. And that's why being diversified and having a broad exposure to all different industries, and sectors is important. We also don't invest in sector funds directly. Some of those sector funds, like the banking sector funds I've seen, have taken a much, much bigger brunt of that force. So if you're invested in those types of mutual funds, I can tell you that they obviously saw the biggest reaction to this news as it broke over the last couple of days. As for, let's say, the holders of SVB CDs, we do build CD ladders, brokered CD ladders, and treasury bond ladders for a lot of our clients. We personally did not have any CDs that were impacted by this, but we easily could have. That is why it's important to make sure that FDIC limits are respected when you go and kind of implement ladders and invest with institutions. So we always are making sure that we're under that 250,000 per bank, 500,000 in the case of joint accounts, to make sure that there is no exposure when you're building these ladders for clients. And I think in that same vein, FDIC and what we call SIPC insurance, which is what covers custodians, is another topic that a lot of clients have brought up. Some of you may be aware that Charles Schwab's name was pulled into this mess, and Sax Wealth Advisors primarily custodies assets for our clients at the three largest independent custodians. So that would be Fidelity, Charles Schwab, and TD Ameritrade. And if you may know that TD Ameritrade is in the process of merging into Schwab. So really Schwab and Fidelity are the two big ones going forward. So with Schwab's name in the news, our phone started ringing. What many people may not know is that both Schwab and TD do have a bank side to their practices. And with Schwab, it was the banking side that was under scrutiny, which is different than the custodian, which is who we use to custody assets for our clients. Key difference there being that when you're dealing with a custodian, they're holding investments on your behalf in a brokerage account or in an IRA, et cetera. And they're basically just holding them, not necessarily reporting those assets on their balance sheet like Jerome just went through. So if that bond is showing a loss, it's going to reflect that loss in your account as a client of that custodian, as opposed to an investment that the bank is making to try and make a profit on behind the scenes. So it's very important when talking about these custodians that do we have FDIC insurance? In the case of Schwab, Fidelity, and even some of the options at TD Ameritrade as well, we have FDIC insurance on cash holdings at some of those institutions. Not every holding that's a cash holding is FDIC insured, but there are options at all three that provide that, and especially at TD Ameritrade, I know most of our clients have that in place there. As well, kind of beyond that, SIPC insurance, which is similar to FDIC insurance, although it doesn't have the same federal backing that the FDIC does, but it insures all the large brokerage and custodians against failure. And so that's generally $500,000 per registration, as well as another $250,000 on cash. So, that is an important aspect of protection that our clients and most clients who are at brokerage and custodians have as well. And it's important to note that it is different and removed from FDIC and applies differently between banks and custodians. Beyond that, I think the other biggest piece that most people are curious about is, okay, when will all of this craziness within markets end? And honestly, for our clients, as well as for most people who are well diversified in their investments, they're going to experience some turmoil in markets as they sort out what this means for the industry. But we feel that certainly our own portfolios are resilient and built to withstand these types of events, and come what may, we have protections in place to make sure that everybody can sleep well at night when they're investing. The last thing that I'll kind of note is Sax Wealth Advisors does have access to some investments, mainly a cash option that can increase FDIC insurance by way of basically you can deposit up to 4 or 5 times FDIC limits, and there's a relationship where they're basically contracting with multiple banks behind the scenes in order to provide you with a higher FDIC limit at one place. So there are options, but ultimately making sure that you are aware of FDIC and SIPC levels, that you're diversified in your investments, and that as you're building, let's say, CD and bond ladders, that you're respecting these limits. Those are the best things that you can do to make sure that this event and other future events don't impact you negatively in the markets. So with that, I think those are the main points I wanted to have. Jerome, anything I missed that you wanted to add there?
No, I think you covered it.
Great. So then last but not least, I think we have a Q&A section here. And thus far, we haven't gotten any questions, which I think is pretty surprising. We did have a couple ahead of time, but please, if you want to type anything in, now is the time. You could use the chat or the questions box and type that in. I know we had one or two ahead of time. Jerome, maybe I'll tee up one or two of these for you to start us off while people type in. One that was related to big banks versus small banks, which will our money be more protected at? And in that same line, people are asking about some of the local banks, which I know you addressed briefly there, but I think that's also a talking point that you can wrap into one.
Yeah, I think, and sorry, as you were saying, I saw one commit too. Look, I think in terms of I think it's important to be cognizant of what's going on in terms of the local banks that got in earlier. We went over some of the major ones and we thought that from a balance sheet perspective, right, from a liquidity and a solvency perspective, we were very, very happy with what we saw. And if you even notice how some of them performed, specifically Valley, on Monday, it looks like they actually outperformed most of the banking index, as well as some of the other ones, and did not take the same hit. So people who were digging in were doing the same kind of work instead of just selling off every bank in terms of an equity perspective as an investor. From a capital perspective, I think they're very well capitalized locally. Their businesses are generally a little bit simpler. Not getting invested into exotic products, a lack of exposure to crypto, especially taking it on a deposit side and putting it on your balance sheet is very risk adverse, and something that the Fed probably likes to see that you do not have exposure to crypto. That's not to say anything about the investment. We're not making a statement about that today at all. We're just making it in terms of funding your actual bank. So we feel pretty good about that. Is that pretty satisfactory, Jeremy?
Yeah, I think that was a good answer.
I saw a question come in. What is happening at Swiss Bank, and should we be worried? Is this going to worse than U.S. banking system? I will take it, Jeremy, and I'll let you follow on. I think by Swiss Bank, they probably mean Credit Suisse. Would you agree?
That's what I believe that they're implying there, yes.
Perfect. So if you think about Credit Suisse has had a lot of issues going back for about 3 or 4 years now with its risk management framework, both in the U.S. and abroad, relating to different products, some of which were addressed last year as they were holding the bag on some quote unquote bad risk management trades by hedge funds. So they've already been under scrutiny a little bit before that. I think the U.S. the view on the U.S. has been that an exit might be imminent sometime soon. They've pared back a lot of the U.S. operations. With that, they are still a very major player in the U.S. market in terms of kind of more of the corporate banking than the personal banking side. So they lend more to the Coca-Colas of the world than the kind of regional contractors. If you want to think about their banking relationships in that place, they also have a very big institutional book that covers hedge funds and insurance companies. So that would be a systematic risk. They're also very large in Europe, so any weakness in their system would cause concern in the global banking system. So that is so yes, Credit Suisse should be one to watch. More on the global side, I don't think it will impact your local relationships at home, but that one would be very, very systematic, more so probably than an SVB or a signature bank. With that being said, if there become major issues there, you can expect multiple governments to get involved and to ensure that there's a lot of watch and regulation on this, as I'm sure there probably are now. All right.
Great. I don't think I have anything to add on that because you certainly articulated more than I would have been able to.
What's the next one?
Yeah, there's some here related to assuming the Fed is taking over the bank, will all assets, loans, investments need to be held to maturity to ensure that the Fed/taxpayers doesn't lose any money on the takeover. So the takeover could last years is the question.
Yeah, so one thing to note that's pretty fascinating, and I was fortunate enough to spend a year of my career, a small portion of my career working at the New York Fed and working on their operational risk management before I went to Citigroup, was that the Fed shuts down a bank, that the Fed takes over a bank quite often. This happens nearly at times, almost every week. Now, a lot of times they're a single branch bank that you don't hear about, and you might not even know about, even if you're a customer there, unless you look at the fine print, because somebody else is servicing it. So, the Fed will not necessarily rush to sell all the investments off at a loss. Instead, they will try and maximize liquidity, and then potentially look for another buyer or partner to buy portfolios of assets. So despite these banks closing, the Fed still feels pretty good about finding a bank for some of these kind of quote unquote books of assets. So if you think about how they'll wind it down on the size of SVB or Signature, first they'll likely try and find another bank to backstop the losses. And how they do that is maybe a bank has the exact opposite exposure, right? So they have a lot of cash to invest now, or they have a lot of high interest rate. They have a large investment portfolio that's paying well, that's invested now, and they can't find loans to service. They can easily take over some of these loans and deposits and pay it out the other way to reverse asset and liability mix matching. So there's a lot of tools they have. Yes, ultimately they could hold it to maturity, and the taxpayer could take a potential loss. But generally, they try and find a more creative solution to solve liquidity needs and to help out others in the system. So it's not necessarily like an auction that they just get the assets and just sell automatically like a liquidator.
This one I may actually be able to add something to. Do you recommend we have at least 2 bank accounts? We typically need to keep more than $250K in an account to run our operations. What do you recommend in this case? And there's also another question that's very similar. What measures can we take as a business to not be impacted if the balance of our account stays higher than the FDIC limit, or if something like this were to happen to another bank? So I think both of those kind of go hand in hand with the answer. So from, Jerome, maybe you want to opine there, but from our perspective, I guess one question would be, how much are you exceeding FDIC insurance by, and how often are you exceeding FDIC insurance limits by? Because those are 2 factors certainly to take into account there. If you very rarely or occasionally cross that threshold, it's very different than if you're sitting with $1 million in a single financial institution all the time. So one of the solutions that I alluded to earlier that we offer sometimes is you can get up to, I think it's 4 times FDIC insurance limits in the case of a business and 5 times in the case of an individual coverage through, certain, solutions that we have access to. And the way that works is there's actually a stable of 4 or 5 banks that behind the scenes, you're depositing money into quote unquote one account. Behind the scenes, they're actually opening up 4 or 5 relationships with banks in order to get you covered by more than just the singular FDIC limit coverage that you would otherwise have. So that is a solution, especially that we use for clients who have a need to sit on a large amount of money for an extended period of time, while still getting, high yield savings type rate on their deposits there. Jerome, do you have any comment there on?
Yeah, I would say this, from a risk perspective, I would think it would be thoughtful and relatively easy in this day and age to have at least 2 accounts. And if you want to eliminate, let's just say, forget the bank risk. Let's just say there's business disruption or operational risk. Like, let's do something non-morbid. Let's say your bank had a bad flood and something happened, and nobody could get in the bank and like the systems are down, yada, yada, yada. You still need to do things. I would recommend having a month to a month and a half of kind of fixed costs, payroll, rent, other expenses in a separate bank account that you can easily access to be readily available to help kind of like as a backup. So it's, kind of around not necessarily the FDIC issue, but just as an operational perspective, like you never know, something unforeseen could happen to any bank, right? A hack So I don't think there's any issue in having a second bank. Now, having 10, probably not overly efficient unless there's an actual commercial reason for it.
I agree with that as well. The next one here, and these two we can kind of probably talk about in concert as well. What will occur with lines of credit and/or credit loans at SVB and Signature? Will they all be cut and called? Signature is a lender in New York City for construction projects. How are the construction loans impacted?
So I would say, I'll start with that. Generally, the line, so if you owe money, you still owe the money, is that part. If there's a line of credit available to you for working capital purposes, my guess is it was either greatly reduced or B, it might be frozen and you might not be able to tap it for more. Now, Signature and others will work to have somebody else service the business, and servicing the business from the Fed's perspective means as operationally uninterruptible as possible. And what do I mean by that? It's, can you service this business? Can you take on these lenders? And is this an area, these customers, and this is an area you want to be? So they would hopefully look for their construction portfolio, or for part of it, somebody who wants to be operationally in this business in the Northeast, right? Or wherever the concentration is. So somebody can come in and say, okay, yes, you've got the deposits, great. And most of our banks can do that. You're collecting payments on loans, great. Most of our banks can do that. But we want somebody who wants exposure to the American small business that can do this. That's absolutely critical when the Fed goes in there and has discussions. And unfortunately, that takes a little bit of time. But back to the earlier slide, that's part of the trust and community banking, where not necessarily we don't want all of our money at the 4 major money centers, because we want those lenders who are thoughtful into different markets that the big guys might not creatively come down into. And that's not saying that they won't, but if contractors is a good part of Sax's business on the accounting side. And we know that there are certain banks who like exposures to the contracting business, and certain ones who it's not their appetite. So we would, this is just about optionality and about continuing that. So to your question, it is definitely a wait and see. We are here, me specifically, if you have any specific questions about lending and other relationships, please reach out and we can be helpful if you're having some issues to hopefully open you up to other lenders as well. Jeremy, did I answer that?
Yeah, that's what I was going to say. I said, I don't know that we're going to be able to necessarily answer that one at this stage in the game. If somebody currently has a line of credit or a loan that's being impacted. I know, even ironically enough, my wife's firm, she works for banks with SVB, and a lot of their stuff is still in flux as far as how they're working through it. And as you said, the FDIC works very, very quickly and efficiently, but we're still early on with all of that. Let's see, we had just got another one here, but I'm not aware of, there's a question here, are there any resources available online to see the strength of a specific bank?
So I would say yes, there are. However, the analysis of a bank is very technical. There's capital adequacy ratios that you can read into. If you have a direct concern, again, we can guide you through some things to look at or some measures to take a look at. Again, a lot of these are off of statements that could be 2 to 3 months old. But I would encourage people to read the FDIC. Although it might sound antiquated and old and boring, it's actually a pretty good resource, and they give up-to-date commentary and some views on certain things. So while yes, there is technical bank analysis, but these spreadsheets can be dense and to be nice. So there are a number of resources. Please, reach out and we can kind of point you in a direction. But some of it again is more situational. But I would start with the FDIC website. They're generally pretty good. We can also, if you wanted to get into the weeds and see regulatory filings, we can point you there as well.
A follow-up question on that, Polk and Bauer, do they still exist for bank review?
I have to get back to you on that. I don't want to speak
for that either. But to my knowledge, there isn't like the equivalent of a charity navigator, so to speak, for banks where you can go in and see under the hood, and it gives them like a thumbs up or a thumbs down rating to my
No,
knowledge.
there is. It's just not as public, right? So Moody's and the big rating agencies rate banks, financial institutions, insurance companies all the time and do reviews. Unfortunately, a lot of times they're reactive. So Moody's was about to cut SVB's credit rating, right, after some of these issues. So those are generally on Moody's website and S&P. They will give you kind of a preview. To get a full subscription of their rating reports, it is usually pretty expensive, but the publications come out. Now, generally, when you see a rating downgrade, you will see a change in stock price as they are getting information at real time, as they are privy to information ahead of even sometimes investors because of the credit lens they put on things. But there are resources available, and we can again point people in that direction.
One more question here that it's pretty big picture, but worst case scenario and these bank runs continue, how long can the Fed step in and continue to guarantee all deposits?
It's a good question. I mean, hopefully the recent action, stabilizes this. It looks like, knock on wood, there has not been a run on the deposits, and people are pretty comfortable because everybody's getting their cash out. So that is the first good sign. That is a very strong sign. Now the bank equity market going down, that's a little bit different in terms of risk tolerance. But in terms of as a depositor, to answer the question, it seems like that hopefully won't be an issue. But if it were to become one, the bank has the government has a cash register, right? I mean, there would be other fallouts, inflation and other things if they were to print more money to backstop all of these and then somehow figure out how to have the banks pay for it. Similar to 2008, if you recall, the bank did a TARP program, which was toxic asset relief protection, where the government backstopped the largest financial institutions in the world. And the taxpayer actually ultimately got paid back and made a 15% return from the banks on that investment, although it took 3 years for the most part. We would hope something like that is not in place, but there are dramatic backstops that are available to the government to guarantee all deposits if that were to become an issue.
And then the last one I really see here that we haven't really answered, it may be something to take offline. What do you recommend if a letter of credit is being held as collateral through SVB? That may be a one-off that we want to discuss more directly, but I don't know if you have any thoughts there. But
yeah, I would do two things. A letter, I think it's fully collateralized letter of credit by the bank. I would check immediately with the servicer, right? So I believe SVB is now in receivership from the FDIC. So my guess is they're keeping the collateral on the line of credit because that is a loan product from them essentially. So that should still be good. And my guess is they'll want to change that collateral hands. I would reach out first to them, and my guess is you're probably asking this question because the line is probably very, 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 very saturated with calls and service, which is the operational disruption. I would then reach out to another bank or another potential partnership that you have that you feel comfortable moving things to, and then see what their appetite would be to assume a letter of credit and give them maybe the same lending package that you have and bring them up to speed. I would also reach out to the other side of the party on the letter of credit, like who's getting that letter of credit, who's the beneficiary in that place, or who would be the reason you have to put it up. And then just work with them and have them potentially understand that you may need to move this in this time. A lot of times that's put up there for a number of different reasons. And again, we're happy to discuss one-off because if it's for an insurance bond or if it's for a construction loan or if it's for a different project, it could have very different meanings, if it's with the government or a private company. But yeah, we appreciate it's a precarious situation.
okay. I believe that's all the questions for the most part that we had there. Naturally, if there's anything else you think of after we wrap up here for the day, please don't hesitate.
I see one on how do we anticipate this would be going forward for regional banks, regulation, valuation, profitability, business models, et cetera. I think it's a good question. There was a thought that, again, we're not taking the political side here, that some of the regulations that were rolled back during the 2018 Trump banking bill or repealed banking bill would have stopped this. And perhaps you can make the argument, yes, but then if you go to the argument, but then if you go to the other side, that one of the people who was the original author of that bill was sitting on the board of one of these banks and had direct insight to ensure that oversight, nothing was done. I would just call it a toss-up. So will new regulation come into place? Yes. The issue is regulation probably wouldn't have helped SVB, just given the nature of what happened. It might have allowed them to stop originating loans, but it could have just shifted the issue to a different place. But I would definitely see a near-term increase in regulation on smaller banks, which obviously more regulation, more expense will increase profitability, which will probably lower value. I'm not a banking analyst, but will probably lower value of banks for at least a little bit in the short term. But hopefully there are safety measures put in place at a cost-effective manner.
Wonderful.
And we will send out, and I see a couple of questions, we will send out the deck tomorrow to the group.
And I believe this is also being recorded, so we maybe have access to that as well.
Great.
Wonderful. Well, thank you all for joining us. If you do have any follow-up questions, don't hesitate to reach out. If there's any other way we can be of service, Jerome and myself will always make ourselves available. And I hope you have a lovely rest of your week. Thank you.